Assalamualaikum warahmatullahi wabarakatuh. So today me and my group, which is Adib, Danial, Ilham and also Syamil, we're going to make a presentation about financial statement analysis of two companies, which is Hartalega and also Top Glove. So for the first part, which is financial statement analysis. The purpose of financial statement analysis is to understand and determine information contained in the financial statement with a view to judge the profitability and financial soundness of the firm. And by having the information from the financial statement, we can make forecasts about future prospect of the firm. For the analysis tool, there are a lot of it, but I only give you guys two examples, which is liquidity ratios and also asset management ratios. Okay. Next, we're moving on to the second part, which is accounting ratio and analysis. We have 5 ratios we need to be calculated. For the first one, which is liquidity ratio. The purpose of liquidity ratio is to measure how much of the company's assets are liquid, which can be converted to cash and quickly at low cost. Okay. So here is a table of liquidity ratio. Under liquidity ratio, we need to calculate two things, which is net capital working and also current ratio. For the net capital working, the formula is current asset minus current liability. The current asset and the current liability information can be get from company financial statement. So for this calculation, we use they have two information, which is company and also group. We use group information. So here's a table for net working capital for Hartalega. So the net working capital, the amount for each year on above, which is 2018, 2019, 2020, is positive. This means that the company has enough current asset to meet its liabilities. If all current liabilities are to be settled, the company still has some amount of money left to continue the business. Next is net working capital for Top Glove. So Top Glove, the comment is kind of same, which is 2018, 2019 and 2020. The amount is positive. That means company also has enough current asset to settle their current liability, and they still have money left. Next is current ratio. Current ratio, the formula is current asset divided by current liability. Same as net capital working. The information we use is group information and can be obtained from the financial statement. Okay, so for the current ratio Hartalega, the current ratio results in amount greater than 1 for the 2018, 2019 and also 2020. This means that Hartalega has adequate current asset to settle its current liability. For the year 2020, the current year is 203.73 times larger than the current liability, which is great. That means for one ringgit of current liability, company has 203 ringgit 0.73 cents to pay for the current liability. Same goes by the previous year, which is 2019 and 2018. Next is Top Glove. My comment on current ratio for Top Glove is the kind of same for Hartalega. They result in positive for 3 years, which is good. And I think it's kind of same. For 2020, Top Glove has 549.41 times current asset compared to current liability. That means for 1 ringgit current liability, the company has RM 549.41 cents to settle the current liability for each 1 ringgit. Okay, moving on to the next, asset management ratio.
Okay, for the purpose of asset management ratio, it is to equate a company's asset to its income. Asset management ratio show how effectively a business uses its asset to produce sales. Asset management ratio are used to determine how efficiently and effectively an organization use its asset to generate revenue. They signify a company's liability, eh, the company's ability to convert its asset into revenue. Asset turnover ratio and asset performance ratio are example of asset management ratio. So next, we begin with Harta Lega Company. So the formula is total asset return ratio. It says divided by total asset. Okay, for the Harta Lega, that I compute that total asset turnover ratio from 2018 to 2020 above shows that 2018 got the highest ratio, which is 0.44. This means in 2018 Harta Lega Sedia Berhad only generates 44 cents. That shows that Harta Lega startup in not very efficient with its use of assets. However, from year to year, the ratio depleted until 50 cents in 2020. To improve this, the company need to increase the sales to get the better ratio. Next, we move to top, top glove. So as you can see, from 2018 to 2020, total asset turnover ratio is between 0.21 until 0 as a lowest and until 0.51 as a higher. It is not the higher ratio for total asset turnover, but in 2020 is the highest ratio, which means the company generate revenue from its asset based efficiency rather than 2018 and 2019. In 2019, got the lowest ratio indicates that the company is not using its assets efficiently and may have internal problems. Okay, next, we move to non-current asset turnover ratio. So the formula is sales divided by net current assets. Okay, for the Harta Lega, according to annual report from 2018 and to 2020, total sales decreased, and because of that, the non-current asset ratio going low after 2018. Total sales in 2018 is 620 billion, 520 million. So it decreased 38% until 2020, while the non-current asset keeps increase year by year, which is increased 3% until reach 1.5 billion. To compute, the ratio keep decreasing year by year, which means the company may not using its assets effectively. Next, we move into top glove. According to non-current asset turnover ratio from 2018 to 2020 above, it states that in 2020 compute the highest ratio, which is 1 ringgit and 1 cent, rather than the other years. It shows that in 2020, the company using its asset effectively, using its non-current asset. While in 2019, the company compute only 21 cent ratio, which is the lowest one between 2018 until 2020. Because of the company may indicate the business is not using its asset effectively. So next.
Okay, for the debt management ratio, debt management ratio indicates the degree to which the activities of a firm are supported by creditors' funds as opposed to owners, and it also highlights the ability of the firm to honor its medium and long-term debt commitments. Okay, next, in this debt management ratio, there are a lot of different ratio, but we just take two here. The first one, which is equity ratio. The formula for equity ratio is shareholders' equity divided by total asset. As we can see in the screen and in the table, these are the percentage of equity ratios for Harta Lega Holding and Top Glove for 3 years, which is 2018, 19, and 20. We can see that there is similar amount, which is the two companies have over 99% of their equity ratio in these 3 years, which means they use most of their equity, shareholder equity, to secure their funding in their business. Okay, next. Move on to the next ratio, which is debt ratio. The formula for debt ratio is total debt divided by total asset. Total debt and debt ratio for Harta Lega Holding in 2018 and 2019 was 0.50%, while in 2020 is 0.10%. We can conclude here that this company, based on calculation, the company was also a conservative company, which is their debt ratio was below 50%, and the business only used small amount of debt to fuel their funding. Okay, for Top Glove, their debt ratio in 2018 and 20 was 0.04%, while in 2019 is 0.07%. Based on the information given, this company has risky chance because the debt ratio is below than 50%. So that's all about the ratio.
Okay, now we go into the profitability ratio. So purpose of profitability ratio is used to evaluate the company's ability to generate income as compared to its expenses and other costs associated with the generation of income during a particular period. Next. Now we'll start with the net profit margin. Net profit margin formula is net income divided by net profit. So as you can see, for Harta Lega, net profit margin on 2018 was very high. It shows that the company generate a huge profit, but on 2019, the net profit margin dropped down to only 11%. Maybe it's because of the company uses an effective cost structure. And on 2020, the company once again reached its highest net profit margin with 101%. On that year means that the company has a strong pricing strategies. While for Top Glove, this company net profit margin on 2018 was very low with only 9%. With only 9%, is because the company used a high cost in its operation, different with year 2018 and 2020. This company showed a great performance with a very high net profit margin. Maybe the reason of this great performance is they practice a strong pricing strategies of their product. And next slide. The next slide is for gross profit margin. Purpose of gross profit margin is it can show whether the company's sales are sufficient to cover their costs or not. It is also important to assess the company's financial health by calculating the amount of money left over from product after subtracting the cost of goods sold. Next slide. As you can see, both company have the same amount of gross profit margin, which is 100%. This shows that in all 3 years, these companies can maintain their cost of sales and well managed. Besides, this company has more to cover for operating, financing, and other costs. That's all for profitability ratios.
Alright, so purpose of the market ratio. The purpose of market ratio is the market value ratio helps to evaluate the economic status of publicly traded economy, publicly traded companies, and can play a role of identifying stock that may be overvalued, undervalued, or priced fairly. Market value ratio are also used to analyze stock trends. For example, a company low price earning ratio may indicate the stock is an undervalued being in a stable industry. But it also could indicate the company earnings prospect are relatively uncertain and the stock may be risk back. Right, so next slide.
Alright, so this is a formula of the earning per share, which is total earning or profit after tax divided by number of share issued or outstanding share, right? So this is the calculation of the earning per share for both company, which is Hartalega and Top Glove. The formula of earning per share is profit after tax divided by number of share issues. So the earning per share for Hartalega for the year 2018 is 0.19, which is great. For 2019, which is 0.07, and for 2020 is also 0.07. So we move to the Top Glove, earning per share for Top Glove. For the year 2018, the earning per share for Top Glove is 0.18. For 2019 is 0.08, and for the year 2020 is 0.60, which is quite high. So my elaboration based on the earning per share for both of the company is we can compare the company performance of both of the company using the company's net income and the number of outstanding shares. For the company net income or profit after tax in 2018 and 2019, Hartalega Holdings Berhad has a better net income or profit after tax compared to the Top Glove Corporation Berhad. However, in 2020, Top Glove net income or profit after tax in 2020, Top Glove net income or profit after tax Berhad is greater. However, in 2020, the Top Glove net income or profit after tax is greater than Hartalega net income profit after tax. For the number of outstanding shares, the Hartalega Holdings Berhad have better compared to the Top Glove Corporation Berhad for all the years, which are 2018, 2019, and 2020. So based on this information, we can conclude that the Hartalega has a better performance for the year 2018 and 2019. Unfortunately, for the year 2020, Top Glove start to show that they have a better performance for the company's net income or profit after tax. Alright.
Okay, moving on to the third part of the presentation, which is comparison of ratios between company. I go as fast as I can. So for the first comparison, which is liquidity ratios. Okay, liquidity ratios for the net working capital, as we can see for the 3 year 2018, 2019, and 2020, we can conclude that for the 2018 and 2019, Hartalega has better net working capital, but on 2020, Top Glove has better net working capital. For the current ratio, as we can see on the table, for the 2018 and 2019, one more time, Hartalega has better ratio compared to the Top Glove, but however, on 2020, Top Glove has better ratio compared to the Hartalega. So what we can conclude from all of this data that on 2018 and 2019, Hartalega is more efficient in handling their current asset and also current liability. However, on 2020, Top Glove proved that they also has better performance in handling current asset and also current liability. Next is asset management ratio. For the 2018, for non-current asset turnover, 2018, 2019, and also 2020, we can see that for 2018, Hartalega has better ratio compared Hartalega has better non-current asset turnover. However, on 2019 and 2020, Top Glove has better non-current asset turnover compared to Hartalega. For total asset turnover, same as non-current asset turnover. Hartalega only has better non-total asset turnover only for 2018, while Top Glove has better total asset turnover on 2019, followed by 2020. So from this, we can conclude that Top Glove on 2020 and 2019, Top Glove has more efficiency in handling asset and also in handling asset and also sales compared to Hartalega. However, Hartalega still has better efficiency on 2018. Next is debt management ratio. Debt management ratio, so this is the table that indicate all information in debt management ratio. As you can see, we can compare company performance of both company using equity ratio and debt ratio. For equity ratio, for all 3 years 2018, 2019, and 2020, Hartalega has better ratio compared to Top Glove. This means that Hartalega has better finance of its asset with shareholder equity. For debt ratio, for all 3 years 2018, 19, and 2020, Top Glove has greater ratio compared to Hartalega. However, greater ratio doesn't necessarily means it has better performance. In debt ratio cases, the company has lower ratio, has better performance. This means that Hartalega has better performance compared to Top Glove because the percentage of the performance compared because the percentage of debt they use is low to secure their funding. So using debt management ratio, we can conclude that Hartalega has better performance compared to Top Glove. Moving on to the profitability ratio. Okay, so for profitability ratio, how to compare? We can use net profit margin and also gross profit margin. For net profit margin, we can conclude that Hartalega has better performance since their profit generated progress more steadily compared to Top Glove. The profit in 2019 is only 96% and then skyrocketing until it reached 1,317%. Unfortunately, on 2020, the profit decreased back to 100%. So we can conclude that the profit progress is uncertain and there is risk that the profit is not as high as previous year. For gross profit margin, we can conclude that the both of the company have pretty same performance since all of the 3 years. Both company has percentage of 100% for gross profit margin. For the last ratio, which is market value ratio. Okay. So we use earning per share to compare their performance. In 2018, Hartalega has better earning per share. However, on 2019 and 2020, Top Glove has better earning per share compared to Hartalega. We can conclude that Hartalega has better performance in 2018, but in 2019, except 2019 and 2020, Top Glove has better performance. That's all. Now moving on to the next fourth part of the presentation, which is comparison of ratios with industry's average.
So for comparison of each company ratios with the industry average ratio, we've chose the 4 ratios to be compared with the industry average ratio, which is current ratio, net profit ratio, and gross profit ratio, and total asset turnover ratio. For the starter, let's start with the current ratio for both Hartalega and Top Glove current ratio. Hartalega current ratio is 2.03 and Top Glove current ratio is 5.49 for years 2020. We need to know that a current ratio that is line with the industry average ratio or slightly higher is generally considered acceptable, and if the current ratio is lower than the industry average ratio, it indicates that a higher risk of distress or default. From here, we can see that Top Glove's current ratio were much higher than the industry current ratio. It shows that they have a better management for their asset. Next, let's start with the profit margin ratio. From here, we can see that the net profit ratio for Hartalega is 106 and Top Glove is 100. we need to know that a higher net profit margin ratio means that the company is able to effectively control their costs and provide goods or services at a price higher than it costs. Low net profit margin ratio means that the company has an effective cost structure and poor pricing strategies which result to a higher cost. As we can see that the net profit ratio for both companies, from this ratio, we can see that we can agree that Harta Lega have a more effective control on their cost and a better pricing strategy. Third one. Third one is gross profit ratio. So a higher gross profit ratio indicates the efficiency and effectiveness of operation in the firm, thus highly achieve profits. So the company that have a higher gross profit ratio than the industry gross profit ratio show that they have more efficient and effective operation. For both company, Harta Lega and Top Glove on year 2020 have a same gross profit ratio which is hundreds, while the industry average gross profit ratio is 27.46. By this, we can say that both companies have same efficiency and effectiveness operation in their firm. And the last one is total asset turnover ratio. Total asset turnover ratio. This ratio is one of the ratio under the asset management ratio and help us to measure how effectively the firm is managed. The firm manages its asset in order to generate sales. It also shows efficiency in collecting debts. A high turnover indicates that the company know how to use their asset effectively. Plus, they also can attract more investors to their company. As we can see here, the industry average ratio is 0.97 and the total asset turnover for Harta Lega is 0.15 and for Top Glove is 0.51. We can see that Top Glove have a higher ratio and closest to the industry total asset turnover. This is the proof that they have a proper and effective assets management compared to Harta Lega.
Okay, for the cash flow statement, as we know, a cash flow statement has three sections, which is operating activities, investing activities, and financing activities. So, for analysis, for us to conclude the cash flow for both of the company, we need to look at these three main activities. For the first one is operation activities. Cash flow from operation activities is the amount of cash from the income statement that was originally reported on an actual basis. A few of the items included in this section are accounts receivable, accounts payable, and income tax payable. Okay, so based on the company annual report 2020, Top Glove Berhad end up with a net cash generated in operating amounting 9,239,000, which is a positive amount. This is because they had a lot of cash inflow from decrease in receivable, increase in payable, and decrease in inventory. While for the Harta Lega, they have net cash used in operating activities, which is 9,141,096, which is the negative amount. This company didn't have a lot of things happen in their operating activities and cash inflow, and that's why they end up with that amount. Move on to the next activities, which is the investing activities. Okay, this section records the cash flow from sales and purchases of long-term investment, like fixed assets that include property, plant, equipment, PPE. Items included in this section are purchase of vehicles, furniture, buildings, or land. Okay, from the company annual report, net cash flow generated from investing activities in Top Glove were 400 million 453,193,193,000. The major factor to the amount is from dividend received from their subsidiaries, which is over 1 billion ringgit, which is massive. Meanwhile, for net cash generated in financing activities in Harta Lega Berhad were 259,438 and 706 ringgit. A lot of cash inflow in these activities came from income received and dividend received. Okay, for the last activities, which is the financing activities. In these activities, debt and equity transaction are reported in this section. Any cash flows that include payment of dividends, the repurchase of sales of stock and bonds will be considered as cash flow from financing activities. For investors who prefer dividend-paying companies, this section is important since it shows cash dividends paid since cash not net income. It used to pay dividend to shareholder. Okay, for the year assessment 2020, net cash flow used in financing activities for Top Glove were negative 205 million and 27,000 ringgit. They paid a lot of dividend for ordinary shareholders, and this gives a very good reason for investors to join in. For Harta Lega Holding, they end up with negative 164,053,530 ringgit. They also have the same scenario with Top Glove, which they have high amount in dividend paid to shareholders, which is over 200 million ringgit. That's all about the cash flow.
Okay, for the limitation of analytical and interpretive technique. So the ratio analysis is the process of comparing data from financial statement to obtain a general understanding of company's operation, financial status and cash flow. The research is particularly useful for outsiders, including credit analysts, lenders, and stock analysts. These individuals must be able to construct an image of a company's financial performance and status solely based on its financial statement. However, there are a few drawbacks to ratio analysis that should be considered. Next, these are following some of the most important shortcomings of ratio analysis, which is historical information, inflationary effect, change in accounting policy, change in operational structure, seasonal effect, and financial statement manipulation. First, we go through to the historical information. The data used in the study is based on the actual historical reports that the organization has made public. As a result, ratio analysis metrics are not always indicative of potential company result. Then, inflationary effects. The financial statements are issued on a regular basis, but there are time gaps between releases. Real prices are not expressed in the financial statement if inflation has occurred between periods. As a result, once the figures are adjusted for inflation, they are not comparable over time spans. Next, we go to the change in accounting policy. If the company's accounting policy and procedure have changed, this may have a direct impact on financial statement. The main financial metric used in ratio analysis are changed in this situation, and the financial result report after the change are not equivalent to those recorded before the change. It is analyst's responsibility to keep up with shift in accounting policies. The notes to the financial statement section usually contain the change made. Then we go through the change in operational structure. A company's operational structure can change dramatically, affecting everything from its supply chain strategy to the product itself. When an organization undergoes major organizational change, comparing financial metrics before and after the change may lead to inaccurate assumption about the company's success and future prospect. Then we go seasonal effect, and analysts should be aware of seasonal factor that can cause ratio analysis to be restricted. Due to the inability to change the ratio analysis for seasonality impacts, the findings of the analysis may be misinterpreted. Lastly, financial statement manipulation. Ratio analysis is focused on detailed report by the firm in its financial statement. This data could be manipulated by the company's management to show a better outcome than it really has. As a result, ratio analysis cannot adequately reflect the true nature of the market since information misrepresentation is not detectable by simple analysis. It is important for an analyst to be aware this potential manipulation and conduct through due diligence before drawing any conclusions. So that's all for this. So that's all from us. Thank you.